Good afternoon, Quasar Markets Live. So happy to be joined today by the president of the Blue Collar Investing Corporation, Dr. Alan Ellman. Dr. Ellman, how are you doing today?
Doing great. Always good to be with you, Howard.
Always glad to have you here. This is, I believe, our fourth segment here on covered call strategies and the BCI method, the methodology that you guys use there. Um, at Blue Collar Investing. And this thing was amazing to me. I happened to take a look, and I've actually purchased, I didn't tell you this before we came on. I purchased your exit strategy book on Amazon during the last week, and I have started to peruse, haven't gotten too far into it so far, but I was just amazed at all of the different ways that you have. We've talked about what is the strategy of using covered calls and how you use that to lower risk and how to improve returns in general and how you've done this for over 30 years. So I was wondering if you could talk a little bit more about how you actually manage trades once you've identified them and opened the trades.
Well, Howard, I would say that of the different aspects of covered call writing, the one that most retail investors are weakest at is managing the trade. Many retail investors know how to buy a stock or an exchange traded fund. Many also know how to select an option. But then once the covered call trade is entered, how do we manage those trades? And that's a weak point in thousands of covered call writers all over the world in terms of the success of their trades. So one of the things that we stress at BCI is once you enter your trade, your job isn't finished. Now you go into position management mode. And that's really the book that you purchased. Hopefully, you purchased my second book on exit strategies, the one that's for covered calls and cash secured
It
puts.
it, it, it is
Because
it
in
is it
2000,
had both
come
sections.
on, yeah. Okay, good. Because in 2009, I had published a book on exit strategies just for covered calls. And my latest one is much more comprehensive. So I see you pulled up the slide on what are exit strategies. So let's go through that. Um, that's the active management of existing covered call positions. So once we enter the trade, and as you'll see our discussion today, once I enter the trade, I enter one more trade, and that's a buy to close on the short call. What if the price of the stock goes down? So I've kind of partially automated that. And as we go through the slides today, Howard, you'll actually see an example of how we do that. But so you buy the stock, or perhaps you already own it, you write the covered call, and then you put in a buy to close on that short call in case the price of that stock starts dropping precipitously, and that protects us against share price decrease. So those are the things that we have to watch for. What if the price of the stock goes way down? Now, Howard, what if it goes way up,
Right.
much higher than we anticipate? Can we generate more than a maximum return? And the answer is yes, we can. We can actually generate a higher return with our investment when the price of this stock goes up exponentially, and that's one of the exit strategies in that book you alluded to. What happens if new information comes out and all of a sudden we feel we have to adjust our trades? We have to know how to do that. And finally, and these are one of the, I think I have three different exit strategies that I'm going to talk about, even though there's about 14 for covered calls. One of them is learning how to roll an option. If that option is expiring in the money and you don't want your shares sold because you're contractually obligated to sell the shares at the strike price, you may not want that done. So you have to learn how to roll the options. So those are some of the considerations related to management of your covered call positions.
Fantastic. One of the things that I will point out too is that I love the way that you guys over there help your clients by teaching this methodology, but also providing them with calculators that help you decide which stock you should enter and things like that. But also here, you're teaching them about the stop loss, what you need to do, what you have to buy to close to also limit your exposure if the trade starts to move the wrong way.
Yeah, well, one of our spreadsheets that I'm most proud of, Howard, is our trade management calculator, or TMC. And inherent in that spreadsheet, which has over 2,400 formulas within that one spreadsheet, uh, we do give exit strategy buyback price points based on something that I'll mention shortly, the 20%, 10% guideline. So
Okay.
once you enter the trade, you put in the premium you generate, the spreadsheet will tell you, well, buy back that option if the premium declines to X or Y, depending on where in the contract you are. So that's one of the advantages of the spreadsheet. In addition to that, Howard, the spreadsheet will also allow you to make position management adjustments. Over 20 different exit strategies are inherent in that spreadsheet. Now, the screenshot that you just brought up, Howard, shows the book that you were alluding to before.
Yep.
And to the right of that are the exit strategy chapters, 27 of them. The ones that I highlighted in the yellow field are the ones that relate to covered call writing. The ones to the right of that are related to cash secured puts. And all of these exit strategies are inherent in the trade management calculator. So not only will it tell you when to buy back the option, but it will give you the opportunity to make your trade adjustments, something that most retail covered call writers generally don't do. And so with all these opportunities available, you can get returns by not doing them okay, pretty good, to, oh my God, I can't believe I did that, if you learn to master these exit strategies.
And that's so important, like you said, is it's where so much money's left on the table sometimes, or where people burn through their accounts because they think all I can do is buy and sell what I've either already, started in the process, where there are so many other options out there, the way that you can turn these around. I just had on, as you were coming in, you saw Jeremy Vreeland, who works on wheel trades as sort of his style of stuff. And again, another way where he's always selling and buying puts and calls based upon the stock that underlying stock that he owns, and adjusting to the market in front of you. And what I love is that you guys in your methodology, you're adjusting to the market in front of you, and that is so important in a market like we're seeing right now.
Yeah, well, once you learn that aspect of it, it's a little bit intimidating initially, because if you just take a look at the screenshot and you're a beginning option trader, covered calls or cash secured puts, and you look at that and you go, oh my God, how am I
Yeah,
ever going to learn all this stuff? But it does in fact become very much second nature as you start using them. And when you learn the rationale behind these exit strategies and you partially automate it with those buy to close limit orders that
yeah.
we'll talk about shortly, then it becomes, you know what, this isn't so bad. It doesn't take that much time. And I kind of get it. And it becomes second nature. And then after a while, you just kind of automatically do it. And your next door neighbor who's not using exit strategies is going to still beat the market most of the time, but is not going to get anywhere near the returns that you're going to get if you integrate these exit strategies into your methodology.
Absolutely. That was one of the main takeaways that I had from the book already, and I could see and already learning myself and looking at these components that I didn't realize were options to use to limit my exposure or to change the way that I'm in the trade already. So I really appreciated it.
Howard, all of those exit strategies that you saw in that last screenshot, they were the result of real life trading that I've been doing over the last 30 years. Because when I had a trade and I lost on that trade, I would evaluate, how could I have lost less money? How could I have taken that trade and turned it from a losing one to a winning one? And I evaluated I made various rules and guidelines, percentile, buy to close, things like that. And so they're a product of actual real life, not computerized looking back and that kind of thing. It was real life trading. And what you see in that book is something that I've been doing now for 30 years. And, of course, now there's many more than there were 25 years ago. But that's all, everything you see in that book is what I do routinely when I trade covered calls and cash secured puts. Now, the screenshot that you have here, Howard, relates to what I was just talking about before, and that's the automation of the exit strategy process as it relates to share price decline. So back in the 90s, when I started trading covered calls, there are times when, despite all the screening you do, price of the stock goes down. That's just the nature of the market. And I used to say to myself, well, if the price is going down, once it gets down below the break-even price point, I'm going to start to lose money. What can I do about it? Well, we're short the call and we're long the stock. The first step to adjust it would be to eliminate the short call. You can't buy back the stock because then you're in a naked options, very risky naked options position, which most retail investors won't get the trading approval for. So the first step involves that covered call, the short call, buying it back. And I said to myself, okay, at what price should I buy it back? And I spent about 3 years using different percentiles. If you're doing a monthly contract, that percentile is going to be different at the beginning of the contract when there's more time value in that premium than later in the contract. So if you take a look at the screenshot that I added to this slide, if you take a look at a 1 month contract, okay, the time value will decline, but not linearly, but
Right.
rather logarithmically. So you see in the yellow field at the beginning of that monthly contract, the time value will decline slowly. And that's where you have more opportunity to generate more time value profit when you're managing your trades. Later on in the contract, in that brown field towards the end, well, that time value kind of falls off a cliff. So there's less opportunity to generate additional time value premium in the latter part of the contract. And that's why I'm willing to spend a little more money in the first half of a monthly contract, that yellow field, than I am in the latter part of the contract. So it's all based on theta, or time value erosion. And if I could just interject one analogy for your viewers here,
Absolutely.
visualize you buying a car and then pulling out of the dealership and the value goes down. And then a month later, it's down even more. And a year later, it's down even more. That's how it works with time value of options as well. It just keeps decreasing. So if you're going to buy back that option, I'm willing to spend 20% of the original premium in the first half of the contract and only 10% in the second. So the example I have on this slide, if we sold an option for $2 a share or 200 for the contract, then I automatically put in a buy to close, not day only, but good until canceled, GTC, limit order at 40 cents, which is 20% of $2. Now, I usually put a note in my calendar the weekend before the last 2 weeks of a monthly contract, and it just says change 20% to 10%. And
Okay.
that Saturday or Sunday, I'll log in online, and that 40 cents will then become 20 cents. Now, if that threshold is reached, what happens? The trade is automatically executed, and you'll get notification from your broker that the trade was executed, and then you can make your plans for what your next step is. You'll see a couple of examples coming up. But that's how you do it, Howard. Buy the stock, sell the option, and then enter your 20%, 10% buy to close limit order. If you're doing weeklies, it would just be 10%.
Okay. Makes sense there. Um, yeah, I don't have many questions on that. My comment would be, I never realized how the system worked when it came to theta and how it is, not a straight line, but this logarithmic method. And I think it's something that's a learning curve for new retail traders for sure.
Yeah, that by the way, if you're going deep in the money, it does become linear. But for near the money strikes, which is the
Right.
ones we use for covered call writing, it is logarithmic, and that's where the 20%, 10% comes into play. It took me about 3 years to get that figured out, and I've been using it now for another 25, and it's worked beautifully. Okay,
Awesome.
so Howard, I'm a sports fan,
Me too.
and back in the day when I was still doing dentistry, and I never knew the blue collar investor would actually become a reality. I wasn't even looking for it to become a reality. But this particular exit strategy, I just called hitting a double. Uh, in other words, don't settle for a single when you can hit a double. And it works like this. Um, Using the 20%, 10% guidelines, you could see in this particular screenshot here that the trade was entered by the green arrow on the upper left side.
Yeah.
And that's where the trade was entered. And the original option was sold at $1.50. Now, at the green line in the middle at the bottom, the very bottom in the middle of the screenshot, that's where the 10% buy to close, good until canceled limit order was reached. It was just the very start of the second part of the monthly contract. So that 15 cents, 10% of $1.50 threshold was reached, and that option was automatically bought back. What I decided to do here was to wait and see if the price of the stock rebounded, which it did. So if you can just visualize, Howard, and to viewers also, what would a chart look like when the stock is starting at a certain point and then over time declines in price and then over time increases in price? Well, you're going to get a classic V-shaped pattern, which is shown with these red
Yeah.
lines. Anytime I hit a double, this is precisely what the chart will look like. Now, you don't know that second leg of the V is going to actually happen. So
Right.
you have to have a game plan in place. What happens if the price of the stock continues to decline? We'll get to that today. But for right now, I closed it at 15 cents and then I resold it at 55 cents. So that means that I had a net credit of $40 per contract. Now, had I not bought back that option at 15 cents, I never would have been in a position to generate that $40 additional premium. It just would have come back and I would have said, oh, good, the price is coming back. But I would not have generated. So if you had 5 contracts, that's $200 right there
Right.
just for being prepared. So that shows you the value of having those uh, buy to close, good until cancel limit orders in place for every single covered call trade that we initiate.
Right. And that is, you've brought up a lot of things there. Number one, these are not back testing and then trying to prove a point. These are based upon 30 years of proven experience where you've seen these work out time and time again and have honed, like you said, your thresholds, your percentages, all of the different levels that you do things at, and it makes a huge difference in investing. And you can see it here, and that's the perfect example right there. Is that most traders would have gotten that small gain from wherever that initiated, where you start with that first green arrow where it says initiate covered call to that $55 price, but it looks like that was only a few cents, whereas you got to gather that entire $40 through it. So it definitely makes a big difference.
Also, Howard, there's a psychological component to this, and I've seen it time and time again with our members. You can't imagine if somebody gets an extra $40. You would think, okay, that's nice. But the feeling you get by being prepared with these exit strategies and generating another $40 a contract, maybe $200 for the 5 contracts, just motivates you even more to master these exit strategies because this is only one of 14 that
Right.
you can integrate into your strategy.
Yeah, no, that's what I mean. Like I said, I haven't even digested a quarter of the strategies that you have in the book so far, because it is. And what I've started to do is put together now a checklist for myself. Okay, if something drops this way, this is what I want to do. A little cheat sheet, so to speak, for myself on it, just to kind of have it right in front of me in one spot. So I love it.
So what happens if the price doesn't rebound and it continues to go down? This is another exit strategy, a very common one used in covered call writing. It's called rolling down. And what rolling down is where the 20%, 10% threshold was reached. The option was bought back. Now you're just long the stock, which is currently at a loss because the price has gone down. And you may wait a couple days to see if it rebounds. You can hit a double, but maybe it continues to decline. And maybe you feel like, well, that's really a product of the market going down. It's not this particular stock. So let me generate additional premium, mitigate losses by closing, which was already closed, the original short call, and setting a new one at a lower strike, but still higher than current market value. So when I roll down to a then out of the money strike. So if the price of the stock goes 55 to 50, then I might, if I had a 55 call in place, I might roll it down to a 52 strike and maybe generate another 30, 40, $50 a contract by rolling down. Now, the disadvantage is that you're capping the upside at a lower price than you paid for the stock. But at that point in time, you're in mitigation mode.
Right.
Sometimes, the stock will all of a sudden out of nowhere come back and you say, gee, I wish I didn't do that. But more often than not, and I should say much more often than not, it will generate additional premium that will help mitigate the loss or sometimes even turn a small loss into a small gain. So you have to be prepared. And it all starts with that 20%, 10% buy to close, good till cancel limit order. That's where it all starts.
It makes sense. And like you said, is it's not about taking, what was a loss and all of a sudden turning it into a home run. It's about mitigating what your loss is and trying to get back a little bit of that loss and maybe turning, like you said, into a profit. I think sometimes people get so worked up on numbers that they don't maximize. The idea is to maximize the trade, right?
You have to know that no matter how good you are at these strategies, because we're seeking to generate higher than a risk-free return. So by definition, we're all willing to incur a certain amount of risk. That'll vary from investor to investor. But that means we can lose money. And so not every trade is going to be a winning trade. But if you could manage your trades so that your losers are mitigated using exit strategies and your winning trades maybe even enhanced through the use of these exit strategies, then you're going to almost always have one great month after another. You're never going to hit that grand slam home run that you talked about, but you're going to be hitting singles and doubles all over the place.
And that works in the long run for all traders, not just certain traders. And like you said, is I think a lot of times where traders don't understand is it's just about as much as limiting losses as it is about getting those wins. And too many traders have burnt out because they allowed losses just to go and multiply and multiply and multiply sometimes.
Oh yeah, that's a sad reality. All right, what happens, Howard, if the is that the next slide,
Oh, I
number
think I
8?
went by
Did
it.
we
There we go. Sorry about that.
Okay. Um, okay, so what happens if, let's say we bought a stock at 48 and we sold the $50 out of the money covered call. The price of the stock goes up and it surpasses the $50 agreed upon sales price as 4 p.m. Eastern time on expiration Friday is approaching. And let's also assume for a moment, Howard, that we don't want our shares sold. Okay?
Right.
The solution is an easy one. We just buy back the call option before 4 p.m. Eastern time. And then we can then sell the next cycle, whether we're doing weeklies or monthlies. So rolling out is the strategy where we buy back the current cycle's short call and then sell the next cycle's same strike or perhaps higher strike, depending on if we want to take a defensive posture or we want to take a more aggressive posture. Now, as long as we do that before 4 p.m. Eastern time on expiration Friday, our shares will not be sold. Okay, so in this particular example, I'm going to show you rolling out to the same strike, and then I'm going to talk about rolling out to a higher strike, and I'm going to use a hypothetical so that the numbers are nice and even, so your viewers can hopefully understand this rather than getting into pennies and things of that nature. So we buy a stock, and of course, 100-share increments. You have to own 100 shares in order to write a covered call.
Right.
It's one contract is the equivalent of 100 shares of that underlying security. So let's say we buy BCI at 48. Our investment is then $4,800 and sell the out of the money 50 call at $1.50. Now here we are on 10/20, which is the monthly expiration, and BCI is trading at 52, $2 higher than the agreed upon sales price of $50. Even if it's a penny higher, Your shares will be sold the Saturday after expiration Friday if we take no action before 4 p.m. Eastern time. All right. But let's say in this hypothetical, we want to retain our shares. So we take a look at the option chain. What is it going to cost us to buy back that option? Well, the $50 call option, in a previous interview, we broke down intrinsic value and time value. The intrinsic value of that $50 call will be $2. The amount that the 50 strike is lower than current market value of 52. That means if the option buyer exercises the option at 50 while it's trading at 52, they have an unrealized gain of $2 per share. So that's the intrinsic value component of that premium. But there's always going to be a small time value component attached to that, even as we approach 4 p.m. Eastern time on expiration Friday. So let's say 5 pennies, right? So the
Yep.
cost to buy back that option is going to be $2.05. That's very reasonable as we approach 4 p.m. Now, if we go out to the 11/17, the next monthly expiration, that 50 strike is going to generate 350. There's a lot more time value because it's going out a month as opposed to just a couple of hours to expiration. So what's our net credit then? It's going to be $1.45, 205 from the 350. So we have a credit there of $1.45. We'll get to that. What if we roll out and up to the 55 strike? Now, this part is a little tricky, Howard, so
All
hopefully
right.
your viewers will hang in there while I go through this. Okay? Now, let's say that premium,
Oops.
go back to the
Yep,
other
I
slide.
did. Sorry.
Let's say that premium, let's say that premium is $1.95. Okay, the last bullet on this slide.
Yep.
Now you take a look and you go, wait a minute, I spent 205 to buy back the option, and I'm only generating $1.95 for the next one. I'm losing money. But here's what you have to
Right.
think about. Okay, when that stock is capped with the 50 strike, it can be worth no more than $50. When you buy back that option, there's no longer a cap. What is it worth? Now it's worth market value 52. So you
Yep.
have an unrealized share gain of $2, and you have a loss on the option side of 10 cents. So net net, you're plus $1.90 unrealized at that point. Now, if we can move to the next slide,
Yep.
we're going to first address, Howard, the 50 rolling out, not rolling out and up, just rolling out to that same 50 strike, which is a defensive play.
Okay.
Okay, buy to close at 205, sell to open at 350, net credit of $1.45. Our shares are worth $50 at that point in time, even though they're trading at 52 on
Two.
market. So when you're calculating your returns, it's 2.9% for that month. Okay, now there's one other perk for rolling out, and that 2.9% is protected as long as share value does not decline from current market value of 52 down to 50. All right, if it starts going below 50, that's when you start eating away at that 2.9%.
Right.
So that's why rolling out, because you're always going to roll out to an in the money strike. Otherwise, you wouldn't need to roll out if that strike was out of the money. So you're always rolling out to an in the money strike. It's a defensive play. So depending on the chart technicals, depending on your overall market assessment, you'll make a call, and you'll see it in the book, Howard. You'll see it in the book. We give you the concepts behind the decision to roll out or roll out and up. Now
What
let's
is
go to
there
the
a
next.
percentage that you say where you do it, or is it just dependent on the individual stock and what your risk appetite is? Or is there more of one that you do than the other? In your experience, what do you
I
see?
I I prefer if it's a normal to a bull market environment, and the chart technicals are still strong, and most of the time they will be when you're rolling out because the price of the stock is above the strike price. My tendency would be to roll out and up.
Okay.
However, if there's an event coming up, a Fed announcement, a presidential election, or something that I have some concerns about, then I will tend to just roll out. Now,
Okay.
one more thing in that regard, I'm glad you brought this up, Howard. Let's say we had 5 contracts of this BCI and we're going to roll out. We're going to roll out, we're going to roll out. No, you know what? I'm a little more bullish than I am bearish on the market. Hey, roll out and up with 3 of them and just roll out with 2 of them.
I love
You
it.
can
I
ladder
love
this,
it.
you can,
Yeah, it's
right.
not black and white. There's
There's
areas of
no
gray even in that system. I love it.
yeah. Sometimes you're remarkably bullish, you're somewhat bullish, and you could ladder those depend in that regard as well. So everything that we do at BCI, everything is throwing the odds in your favor. It's not guaranteeing success of every trade. Nobody does that.
Right.
Nobody does that, and nobody has that's trying to beat risk-free returns. Nobody has every single trade a winning trade.
No.
So what you want to do is minimize your losers, use your exit strategies to mitigate your losers, maximize your winners using exit strategies, and you're going to have a happy life.
Absolutely. Okay, so now we're getting aggressive. I love it.
We're getting aggressive. We're going to roll out and up. Now, we talked about it before that we're going to have actually a net debit on the option side, which we closed at 205 and reopened the 55 highest strike at $1.95. So, but we have an unrealized share appreciation from 50 because there's no longer a ceiling to current market value of 52. So we're plus $2 unrealized. We have a realized option loss of 10 cents or $10 per contract. So the net unrealized gain is $1.90 per share, 190 per contract. Shares are still only worth 50, and that means we have a return of 3.8% with a caveat. And that caveat is the following. BCI could still go up from 52. So we actually have an opportunity to really hit a home run with this one and make over 7% for the
Wow.
month. So if you kind of like the market conditions, if you like the chart technicals of that security, then you're going to tend to roll out and up. But the mistake that a lot of covered call writers make is they just focus in on that option loss without understanding that the reason there's an option loss is because you paid $2 of intrinsic value to buy back that
Right.
option. And you have to account for that with that unrealized share gain.
Absolutely. Yeah. It's not the trades are intertwined. You can't look at one without the other.
So, summarizing here, um, as soon as you enter your trade, it's not time to go to the mall yet. You've got to put in your 20%, 10%, buy the close, good until cancel limit orders. That's very important. You put that in, and good till cancel means that it stays there until you would instruct your broker otherwise,
Right.
or until the contract expires. Um, and so that has to become an integral part of your strategy. And you have to have a plan in place. You have the book, Howard. You know, you saw chapter upon chapter of situations where you can mitigate losses and enhance your gains. Understand that you are going to have some losing trades. But just as long as you have many, many more winners than losers, and you've mitigated losses and enhanced gains, you are going to have month after month after month of beating the market most of the time. That in a raging, raging bull market, that might not be the case, but there you would have to adjust the strategy a little bit and use deeper out of the money
Trades.
call
Yeah.
strikes to take advantage of that raging bull market. So there are things you can do even then. And there are other things you could do to figure out those deeper out of the money strikes. Maybe we can get to it at another discussion, but you could use delta and you can
Right.
use implied volatility to actually get an idea as to how high that strike can go, and you'll actually be able to quantify the risk of that strike actually going beyond that deep out of the money call strike. So,
Yeah, it's so
to sum
important for
up,
people to realize that volatility that the options market give us a lot of data that shows us where the expected move of a stock is going to go. I don't think a lot of traders, again, retail traders, I hope our viewers are learning that. We talk about that a lot here. Nvidia today, for example, is going into earnings, and there's about a 14% implied volatility. So you sort of can get a range of what you might see. Now, as we've talked about in the past, that's why we avoid it in this strategy. We wouldn't have something expiring the same week as Nvidia's. I am sure if you are in Nvidia, you do not have a covered call sold against it this week like you've talked about in the past.
No,
So I want to thank
no,
you
I
so.
don't.
Yeah, I want to thank you
Yeah,
so much for coming on again and bringing us this knowledge to our viewers, because your system it's just so buttoned up is the word I think I have to use from all of the ones I've seen so far. I'm very lucky in my role that I deal with a lot of different educators and I see a lot of programs out there. And what I have seen so far by your books and by talking to you and what I've seen from the BCI so far is that you have taken 30 years of experience, and really what you do is you've been able to make it so someone like myself who's not an expert can understand it. So I have to give you a hats off to that, because so many times I get lost when I'm trying to learn options that it's overwhelmed me and I just run away, so to speak. And what I've found is that your book and that learning through the BCI method has drawn me more into it. And I actually used the technique yesterday a little bit on what I had in a different type of covered call where I had a call spread to cover my call. But I used some of your techniques yesterday. So again, Dr. Ellman, I have to thank you for that.
Howard, I always enjoy our weekly discussions.
Thank you so much. And we will see you next time on Quasar Markets Live.